Hello and welcome to this Diwali special co-presented by Motilal Oswal. I am Nandita Khemka. The last year has been quite delightful for the market, with the Nifty yielding almost an 30% kind of returns and broader market as well making new highs, and the market hitting never seen before levels despite key events like general elections. Now, as we look ahead, there are quite a few risks looming on the horizon, right? Does that mean Samvat 2081 will see lower returns than the last year? And what should one focus on in the coming year, and what kind of portfolio adjustment should one really make? To talk about that and more, I'm joined by Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth. Feroze, first of all, thanks a lot for joining in on this Diwali special. From the entire team of Money Control, wishing you and your team a very happy Diwali.
Nandita, wishing you and everybody in your team and the viewers a great Diwali and a prosperous New Year as well.
Well, thanks. Let's start with the interview then. We haven't really seen such a Diwali in the last 10 years, right? There's caution in the air. And, in fact, the fireworks have been missing, so to say, if you look at the last couple of weeks. Quite a few risks, as I mentioned, looming on the horizon. In your view, is it the right time to buy the fear?
Nandita, yes. To my mind, yes. I love risks. Very counterintuitive statement. I love risks because वो train को रोके रखता है. Right, ताकि आप train में चढ़ पाएं. Right, so people don't realize, especially people who have more income ahead of you, like Nandita, you're a young person, you're going to earn 10 times more, 20 times more in the subsequent part of your life, working life, than what you might have earned, giving your professional skill. So if risks were not there, next 10 years return would come today. If it did come, so Nandita's next year's bonus will be invested at a higher level. So risk एक ट्रेन को रोकने की क्षमता रखता है. So please look at risks a little more positively. If you look down the 10 years from 2014 till 2024, every year there was a risk, and thankfully there was a risk. And that's what held the return back, so that there's some linearity to Nifty returns. Otherwise, all returns would come in a specific year. So that's point one. Point two, that was a fundamental principle. Now to your contemporary question, so should people buy into this? I would say Samvat has given you 28% on Nifty, 42% on the broader market, 15% more in the broader market. Now, last 1 month, in spite of the correction, you're seeing these numbers. Last 1 month correction is close to 8%. In spite of that, if the Samvat has gone by, now you have to look at glass 80% full rather than 20% empty. It's not even half and half. So that's why I see this Samvat, which has gone by, as great Samvat. And you're getting a Diwali discount, which generally does not happen in Samvats. But your malls give you discounts, your clothings are coming at a discount, your sweets are coming at a discount. And this is the first time in the recent past, stocks are coming at a discount. And how is this a bad news? This is a great news. On a Dhanteras, which is auspicious to buy something, if I'm getting my commodity, which I've been eyeing for so long, at a discount, I would be celebrating.
Right, interesting take there, good opportunity to board the train, so to say, and of course stocks also available at a discount. But, is this a price correction or a time-wise correction, and do you see more downside from here? As you were mentioning, 8% kind of correction from the top. But going ahead, what kind of a quantum of fall can we expect? 5 to 7% or even more than that?
See, I personally categorize falls as a company, with all statistics currently done, I will not bore you with it, as two categories. One which is catastrophic corrections, and the other ones which are normal corrections. Catastrophic corrections we classify as greater than 20% on the index number, which is the Nifty index, from the peak. So 26,200, give or take, is the peak. 20% lesser than that is 5,300 points lower, close to 5,300 points lower. So 21,000 ke niche agar market jaye, we will call it a catastrophic fall. And I think the odds of that is near zero. Near zero, not zero. So I would say catastrophic falls near zero. Probability of 5-7% from here, maybe 8-10% odds, 90% odds that we will take reversals before that, unless something dramatically changes. So I'm giving you as much precise in terms of odds rather than just an opinion.
Let's shift focus to earnings then. They've been quite a dampener thus far. It has been far worse than what was being expected, really. And looking at the performance and the commentary, do you expect rest of FY25 to be equally disappointing?
I personally think the reason why earnings are disappointing is because our expectations have gone up, and last year same time there were upgrades. Now, if you look at but your observation is so right that the earnings are not coming on well. Now, if I read the scorecard as of day before yesterday or the third day before today, 15 companies of Nifty had given in earnings. 44.4% was the weight. The EPS, rupee EPS of the same 44.4%. Last year, same quarter was 111 rupees. Today it is 116.9, which is a 5.3% growth. And that was not was predicted by analysts beginning of the year. So that's a disappointment from double digits straight down to 5.3% for the running quarter, where results are actually coming up. And Nifty 100 is also 6% growth. Nifty mid-cap has thrown up very divergent numbers. I will not speak about that because in the mid-cap and the small-cap index, the constituents change dramatically over a one-year period. So sometimes you're comparing apples and oranges. So to answer your pointed question, Nandita, we're going to have earnings of this year at 1165 for Nifty as against 1048 for the last financial year. If that were to happen, I think the risk of earnings will be out of the window.
Right. Would you be tilted more towards large cap now, given the fact that the catch-up trade, still yet to play out, right? Because mid caps, even on a year-to-date basis, despite a 10% correction from top, have outdone the large caps, right? So right now, the tilt should be towards large caps if you look at the next 1 to 2 years.
Nandita, unfortunately, when you look at large, mid, and small, the positioning is a little more agile. Of course, we have stuck our neck out, and I have particularly stuck my neck out from September last year when most institutions or several institutions got strongly negative on small and mid cap and calling them mad cap and so many other things, which we kept hearing as nomenclature. Now we are 1 year into the full Samvat and there's a 43% outperformance. I've stuck my neck out saying that flows will continue. If they so continue, buoyancy and valuations will be there. But now, giving your answer to your question, large cap heavy, point one. Point two, small cap and mid cap, still another few months, 1, 2, 3 months, I don't know how many. You can be in small cap without being too worried. Once the tide turns is when some small caps will swim naked. And that tide turning is the barometer which we try and check. We have got about 2,300 crores of flows into small cap funds, which are a reasonable lead indicator to what is the sentiment in the broader market. And once that turns negative, and I think it will happen before the next interview or a Samvat, I would not want to say that this is a full 1 year positioning. It could be a positioning for 2 months, 4 months, 6 months. And I'm sure I'll come back to money control to give that point where we think there is an inflection point.
Sure. We'll have you back for sure, Feroze. Yeah, we'll definitely have you back on Money Control again to talk about that. But let's also talk about the frenzy that was witnessed in the derivative side of the market, right? There were a lot of concerns about that. Of course, we saw SEBI coming out with rules to curb the frenzy. And recently, one of the SEBI whole-time members had also said that FNO cannot be a national pastime and more money needs to be channeled into mutual funds as well, in terms of safer investments. Now, while domestic flows have been strong, but do you think the regulators have done enough to ensure that more money comes into mutual funds?
Yes, Nandita, I think I see a regulator of a parent of all capital market participants. Not even a parent, a grandparent, right? Industry constituents are parents, which we are responsible as industry constituent, media, distributor, AMCs, to nurture our investors in the right direction. So I think any action which the grandparent takes, it's unlikely that the children are going to like it at the face of it, right? If I gave my son some medicine, he hates me, but that's the way it is, right? I personally think it was one of the smartest parental action a regulator could have taken on the derivative side. And I'll substantiate my claim with some data. Parental action, which I would really subscribe to, is because if a parent sees 1,80,000 crores of loss to one child, and that child has an unfair disadvantage over another child, which is an institutional player in the derivative segment. Now, we have a derivative desk, a large derivative desk. The head of the derivative desk is a Cambridge pass out, an IIT pass out, and knows the gammas or the Greeks of options, delta, vega, gamma, theta, rho. He knows the second order Greeks, vera, veta, which are the 7 most important elements of derivative pricing. On the other hand, a retail guy is choosing between an app to bet on cricket or to bet on derivatives. So this child, as a parent's view, is always at an unfair disadvantage. So as a parent, he would say, be careful, don't trade in it. Because the other child he has done a 3-year course on delta hedging. He has done a 3-year course to understand options pricing. He knows the Nobel Prize winning formula, Black-Scholes pricing. And that is when he is almost like a person who's far, far more in an advantageous positions. And I was speaking to some people in an event, and this is the great news, which is a nuance of our participants. This is the great news for the regulator. As a survey which I did, which I am duty bound to, is in some events I was speaking to some retail participants and asked them, "Aap derivative karte hain?" So out of the 10 people in each event I asked, 8 of them said, "Yes, some derivative." To those 8 people, I asked them a subsequent question: "Do you do an SIP as well?" 6 out of those 8 said, "We do SIPs as well." So the good news is these are not two separate human beings doing derivative and disciplined investing. 60% or 75% of derivative participants, as per a small survey, like an exit poll, which is what a poll predictor does, says that 75% of derivative participants are also doing an SIP. That means it's the same person who looking for adrenal is also have the sense to do discipline investing, which is a better news than having a mutually exclusive set doing these two.
Right. Interesting point you made. Of course, we have seen SIP flows also at record. A couple of more questions really, Feroze. Since you are a wealth manager, I'm compelled to ask you this question. If somebody has a corpus of 10 lakh to invest now, how should he allocate his funds for, say, 30 to 40% returns over the next 5 years? What should the portfolio construct be here? And how much of exposure should they make towards precious metals?
Nandita, before I get to that answer, because you told me and reminded me of my responsibility as a wealth manager, I would be very tempted to put a foundation stone, which I tell myself subconsciously and all my colleagues, that you have some words which are banned in Anand Rathi Wealth Limited. A bet. What will you bet on? What is the counter? What will you play on? What is the theme to play on? All these, as wealth managers, we subconsciously create a short-term mindset in equity. And then crib, why is the investor a short-term investor? So very important as a wealth manager, I'll give you this example. I was speaking to a CEO of a wealth management or of a financial services group CEO. He says, यार बड़ी problem है, लोग एक साल में पैसा निकाल लेते हैं equity से, we should look at long term. And then I, after a few days, saw an interview on the media of the same person. He used all these banned words. Why don't you bet on this theme? Why, and the research analyst of the same company is producing reports with a 6-month target on a stock. Just visualize if real estate sell-side brokers start releasing reports on the building I'm sitting in. People would have sold and bought their real estate 10 times over in the last 20 years. The reason why real estate is making money, gold is making money, is there is no sell-side analyst who's giving a 6-month target to buy and sell. और हम ही complain करते हैं कि investor long term क्यों नहीं रहते. Right, so coming back, as a wealth manager, we see that as a big duty towards India and its constituents. Now coming to your question, this Samvat, I'm promising myself I'll do my duty a little better. Then second, coming to what should one do? What should one do is first check you should do with your current portfolio. If you don't have 50% in equity and your age is less than 60, you are underinvested in the India story. Correct that at your comfort, which does not destroy your sleep. That's first point. Enough of funding the India's fiscal deficit. India is self-reliant now at a government level. So that's why the ministry is permitting you to decide what you do with your investments by giving you the new tax regime and not forcing you to buy small savings, EPF, PPF. It is a message from the government saying that आपने इंडिया को support कर लिया, अब कोई tax saving का आप उम्मीद ना करें, अपने हिसाब से invest करें. So please have your 50% in equity this Samvat. If you're speaking about cleaning during Diwali, this is the first thing you should do. Second, if you have 50%, make sure that you have a reasonable portion in large cap and use mutual funds, because people don't measure risk is why they do direct equity. I will give you a data of 100 very large portfolios on a risk-adjusted basis. Warren Buffett swears by a risk-adjusted measure called Jensen's Alpha. 90% of the direct equity, large 100 crore plus portfolios, as per Jensen's Alpha, are disasters. People do direct equity because they don't measure risk. The day when they start measuring risk, mutual fund will start making more sense. So please use mutual fund platform and don't get lured by the rich guy saying that वो direct equity कर रहा है, अमीर हो गया है. वो अमीर किसी और चीज से हुआ, right? Direct equity से नहीं हुआ है. So please use mutual fund. These are a few tips. Buy 6-7 funds. Don't be concentrated across 1-2 funds. Don't worry about going to 10-15 funds. 14 is the optimal statistically in terms of equity funds. These
Well,
are a
that's some
few
valuable
tips now.
advice coming in from a wealth manager. But lastly, I have a rapid fire question round planned for you. I'll give you some 5-6 questions, and I want quick answers to that. So let's start that round. Where do you see the Nifty by next Diwali in terms of levels?
I see 15% from the current troughs.
All right. And mid caps or large caps, which is the better bet?
For the next quarter, large caps.
Right. Equities or fixed deposits, which one wins in the current context?
I consider debt and fixed deposit for a long-term investor as smoking. You will get great pleasure today, but will destroy your wealth in the long term.
Right. Thematic funds or index funds, what's your preference?
Thematic, lesser of the evil.
Right. Last few questions then. Real estate or gold, the smarter choice?
I would say two very different choices for different monies, both meant for everyone.
Right. And lastly, a must-read book for young investors who are just about getting started on their wealth journey.
Technical book, but security analysis and portfolio management, SAPM.
All right. Well, with this, we've come to the end of the Diwali special. Feroze, thanks a lot for taking out time and joining in. Of course, wishing you a very happy Diwali once again. Have a profitable year ahead.
Thank you, madam.